Welcome to today's web lesson. This is part 2 of signs of accumulation and distribution. It's important to learn how to identify the signs of accumulation and distribution in leading stocks. And to do that, you need to be able to understand price and volume action. Our goal is to follow the big money footprints. Now, who is the big money? Who's the smart money? They're large institutions like banks, hedge funds, pension and retirement funds, insurance companies, mutual funds. These are the people that move the price of a stock up or down. And if you're able to identify when they're accumulating and when they're dumping stock, it's going to make you a much better trader. Because retail traders are not the people who move the price of a stock up or down. It's the big institutions. First, let's take a quick minute to define accumulation and distribution. Accumulation, for the purposes of this web lesson, will be weekly higher volume with higher prices. Distribution will be higher weekly volume with lower prices. It's often more recognizable on a weekly chart. The reason for that is there's so many fluctuations during a daily chart and daily price action. A stock is susceptible to all kinds of movement due to upgrades and downgrades, economic reports, earnings season results, and various headlines from the news services. Now here's a very simple example of how you might use volume and price to figure out if institutions are interested in any given stock. Here's an example of what it would look like if you applied those definitions to your buying and selling of this particular stock. If we bought when we had higher weekly volume and a higher price, we would have entered on this day. We would have held it until we saw higher weekly volume and a lower price. So see, you have a nice run up here, not bad at all. Then you would wait again until you had higher weekly volume and a higher price. You could have entered here, and you would have held it all the way until you had higher weekly volume and a lower closing price. Now this isn't a holy grail system, but it does show that major institutions are taking an interest in this stock on a weekly basis. Here's another stock where if you had bought when you had higher weekly volume and a higher close, it would have run up to here before you got the sell, which would be a higher volume to the downside with a lower close. These two simple things can give you a heads up when there might be more accumulation or distribution that's about to occur in a stock. It can help you decide when to step on the gas and when maybe you need to put on the brakes a little bit. Now please keep in mind that volume can be very deceiving and it is not a standalone buy and sell signal. To be successful, you have to put everything that you use into context. Is the general market in an uptrend or a downtrend? Is the stock in an uptrend or a downtrend? Is it an old, tired run that's been going up for 5 years and due for a correction? Or is it an early stage base and an early stage idea? In this example, you have the larger weekly volume with a higher close. Could have put you in the stock here. Has a nice long run up before you finally see higher weekly volume to the downside and a lower close. And then it has this little correction here before it resumes with, again, higher weekly volume and a higher close. When you see this higher volume and this higher close around the multi-month highs, that can indicate that you could potentially have a very successful breakout. Here are a few other signs of technical strength or underlying bullishness among leading stocks. You'd see strong relative strength, a strong, clear uptrend, and strong growth. You want to look for confirmation that these stocks are being accumulated. A few signs of accumulation would be a base or consolidation that breaks out, wide range bars to the upside, also known as price range expansion, strong closes near highs, gap ups. You'd like to see that price holding above key moving averages, especially the 20 and the 50 day. It can be shorter term if you're doing day and swing trades. You'd like to see a positive reaction after down days. You want stocks that are going to bounce back quickly and strongly. You like to see them bounce back with strong volume, strong closes. Sometimes support will be tested, or prior levels of support will be tested maybe 2 or 3 times, and you want to see that that stock holds up and stays strong. You like to see institutions step in to defend their stock, especially at key moving averages. It seems like everybody's really obsessed with having a perfect entry, but honestly, a perfect entry is not as important as identifying risk. It's probably one of the most important factors in successful trading. And as long as you know where a stock should go and where it shouldn't go, you'll always be focused on the right side of the trend and the right side of the market. Here are a few signs of bearish signals or clues of distribution. False breakouts where you have a stock, it'll break out of a base, but after about 3 or 4 days, it reverses and falls back to the breakout point or below it. new highs that reverse almost immediately. I'm not talking a small minor pullback. We're talking like a significant reversal or failure. If you see wide range bars to the downside, you don't want to buy on the dip. Let price settle. You like to see that some institutional support kicks in. If the stock gaps down, and if it gaps down and continues lower the next day or the next couple of days, that's a red flag. New Skin comes to mind. If you take a look at their chart, you'll see that they had some serious distribution not all that long ago. When you see support levels that are broken and the stock continues to fall for 1, 2, 3, 4, 5 days in a row, you do not want to buy on the dip. You want to be patient. You want to let the dust settle and see what's going on. When key moving averages aren't holding, like the 20 or the 50, that's never good. And when there are negative reaction to up days, meaning whenever the stock has an up day, does it immediately get slammed back down? You know that there's trouble with this stock and that it is being dumped by institutions. So you want to make sure to ask yourself, where should the stock be going? Stocks should show leadership by going higher. If a stock has been trending higher for a few months, you don't want to see it do a 180-degree reversal. It's not a good sign. Earlier I said it was important to put a stock's price and volume action into context. What do I mean by that? One way you can do it is by looking at the general market. Is it in an uptrend or a downtrend? Or are they going sideways? You can also look at a stock's sector and industry group. Remember, 3 out of 4 stocks will follow the general market. 12% of a stock's price move is directly tied to the strength of its sector, and 37% of it is directly linked to the performance of its industry group. Another way that you can put a stock's price and volume action into context is by looking at the monthly chart. It provides a broader, big picture view of what the stock's doing and can reveal the larger term trend and if that trend might be coming to an end. One of the first things I do when I look at a monthly chart is, if a stock is in an uptrend, how long has that uptrend been going on? In this example, it's been going up for about 2 years with only a few down months. Here you can see it had a nice run up, little consolidation, then finally breaks above resistance and continues to move into new highs. Whenever you see a month close lower than the prior month's close and on large volume, you want to be extremely cautious because that's a sign of distribution. Here you can see it did just that, closed lower than the prior month on increased volume, and then it proceeded to go sideways for about 5 months. Now you could stay in this stock for that 5 months, but that's all dead money, and that's capital that could be deployed in other stocks where you could be making some money. And you don't know if it's going to continue back higher or if it's getting ready to collapse. So it finally breaks above this resistance and moves higher. Then again, you have a month where it's a lower close than the prior month and it's on increased volume. Now, although the stock did close lower than the prior month, it didn't close below the prior month's low like it did in our first example. The next candle you see is an outside month. It just means the open and the close are higher than the prior month's open and close. It's also known as a bearish engulfing candle, and it did close above the prior month's low. And although those are encouraging signs, it's still no guarantee. So it's important to look at weekly and daily charts also. When you look at a weekly chart, there's a few questions you want to ask yourself. One is price action tight or sloppy? Where is price closing in the range? What kind of volume is present? Does prior resistance become new support? And what direction is the weekly momentum? Is the price action bullish or bearish? This is the same ticker as the monthly chart that we just looked at. Just because a stock's consolidating doesn't mean there aren't clues or insights into its strength or weakness. Here we have a week that closes above the prior week's low and is on increased volume. Then we have 3 up weeks, and then we get to the 4th up week. It's a wide range bar, which means its weekly range is significantly larger than the preceding weeks, and it's also up on larger volume than the prior week. The following week it breaks through resistance, has a short consolidation, and then continues to move higher. So even though the stock was below resistance in this area, you can see that there was a bullish bias to the price action that was going on. We had strong closes, we had higher highs, we had increased volume and wide range bars to the upside. So that's how you would put daily price action into context. By looking at the weekly and monthly chart, it gives you a broader view and insights into the longer term trends. When we shift down to a shorter term time frame like the daily chart, you can really see how the daily fluctuations can create a lot of noise and make it difficult to see what's really going on with the stock. That's why you want to place it in that broader context. it can hint or indicate what the probabilities might be. Even on a daily chart, you can see where a higher close on increased volume with a strong close can point to accumulation in a stock. Here you have a wide range bar. It closes finally above the 50 the next day, followed by a wide range bar. Both had strong closes, the second stronger than the first, and then you also had increasing upside volume. And this was all prior to the breakout above resistance and into new highs. Additionally, before that happened, you had this upward momentum on a day-to-day basis here. Using orderly pullbacks to the 50-day or whatever moving average seems to be containing price movement is a great way to get in on a stock. It's a logical place that you could re-enter, and it's also a great place to add to a position. So if you missed a breakout, you have the moving averages, and it doesn't just have to be the 50, it could be the 10-day or the 20-day or whatever moving average seems to be containing the bulk of the price movement. Whenever price holds at one of those key moving averages, that's signaling some sign of accumulation. Buyers are stepping in, institutions are stepping in to support their stock at those critical areas. But you don't want to buy just any pullback. You want to make sure that the pullback is orderly, and you want to wait for confirmation and see that support is kicking in. You don't want to try to catch a falling knife. Another thing I want to point out is that when you see a stock that's finding support at a progressively higher and higher moving average, that can be a powerful sign that it's under accumulation. That can show that there's an acceleration in accumulation and that the stock is very strong. So whenever I see price bounce off a key moving support and move up strongly with increased volume on a wide range bar or just up with a strong close, I consider that a positive sign and a sign of strength. So let's take a closer look at this stock. It had a pivot point of 73.74 and it went to a high of about $80, $81, which is around 10% before crashing. So it had this slight sideways consolidation, wide range bar breakout to the upside, moves past prior resistance, pulls back, and that resistance becomes support, and it continues higher. And as it moves higher, it finds support at the 13-day moving average, and then it finds support at the 8-day moving average, finally moving all the way up into new highs before it has a pullback. When it does pull back, it's a wide range bar to the downside, and it comes in with extreme volume, tremendous selling volume here. Now you don't want to buy on this kind of a dip. You want to wait and let the dust settle. It's not necessarily an orderly pullback. It's a tremendous wide range bar to the downside with huge selling volume. It also violates all the moving averages. It closes below the 8, the 13, the 20, and then shortly after that you can see all the moving averages started to slope downward. Shortly after that, it continues to fall further and falls below the 50-day moving average line. Here you can see it's trying to rally back above the 50-day moving average, but unfortunately there's no follow-through or acceleration into the upside. The stock doesn't continue to move higher, it just kind of bounces around. I call that the 50-day wobble before it finally collapses back below it. Now if you were watching this stock, you might have seen this day and said, well, hey, look, it closed above the 20-day moving average. That's great. But unfortunately the next day it gaps down, which is a distribution pattern. Again, it tries to move back above the 20, then gaps down below the 50 the next day. That's a huge negative. If you're still in that stock, you want to get out of it. That's a definite exit sign, because now the proof is on the buyers. They need to get that price back above that key moving average or to prior highs or to new highs to prove that this dip or this pullback wasn't an anomaly. So to answer that question, would you have sold? The answer is yes, because you had wide range bar to the downside with huge volume. You had a 180-degree reversal off of new highs. Price fell below the 20-day and the 50-day moving average. It failed to rise back above either one. Not only that, as it was struggling to regain its footing, it gapped down, and you had no weekly higher high close. Then you expand your view by looking at the weekly chart, and you can see that you had a weekly close that was lower than the prior week and on higher volume. And as we said earlier in the presentation, that is the definition of distribution. So when you see that higher weekly volume and lower prices, you want to be cautious. And at the very least, you want to consider selling all of your position or scale out of part of your position, and at the very least be cautious. So we had a big wide range reversal. That's a huge red flag. It closed below the prior week's low on heavy volume, and that is a sell signal, at least for shorter term traders. And now the proof is on the buyers. They need to get that price back up above that key moving average or to prior highs to prove that it wasn't a fluke. And you also want to ask, does prior resistance become new support as you see a stock pulling back? If the answer is no, that's not a good sign. Something you also want to keep in mind when you're looking at stocks and bases and trying to determine accumulation and distribution is you may be looking at a stock that has an early stage base, but is it an early stage idea? Here's an example of a stock. It broke out from a price of $27.25 and went all the way up to about $73. The run was from 2010 to 2012. So was this an early stage idea and an early stage base? The answer is no, because it ran up over 268% and it ran up for 30 months. So as I mentioned before, volume alone cannot be a standalone signal. You have to take the bigger picture into consideration. You have to put these price movements within some form of context. And that context can be, is the market in an uptrend or is it in a correction? Is it a late stage bull market or an early stage bull market? What are the monthly charts showing? What are the weekly charts showing? Is it an early stage base or a late stage base? Is it an early stage idea or a late stage idea? All these things have to be factored in when you're looking for accumulation and distribution and the probability of whether or not a breakout will be successful. Here's a stock I think you probably are all familiar with. It's Alexion Pharmaceutical. And we're looking at the monthly, weekly, and daily chart of this particular stock. Some other things you want to consider when you're trying to determine whether there's accumulation or distribution in any given stock is how volatile is the daily range? Where in the range does price close? Here you can see some tight, steady price action. Then all of a sudden it starts to become more volatile and chop around, and then it begins to move up in a steady, tight, orderly fashion. You can also see that it had a lot of closes in the upper half of the day's range. That's always a positive sign. You like to see stocks when they move up close strong. I like to see in the upper 75% of the day's range. Other growth traders and more traditional IBD followers, they'll accept in the upper half or 60% of the day's range. You also want to pay attention to how intense is the volume. How frequent are we seeing these heavy upside days? Here you can see large accumulation, huge above average volume. Where's the stock finding support? What moving average do buyers step in and push that price higher? Where is the resistance? Where would be a possible area that it might consolidate? When might it consolidate? Well, we know that most growth stocks will move up 20 to 25% and then consolidate or form a new base. How many new high reversals has it had? That means it moves into new highs and then pulls back. And how does it behave normally when it does that? You can predict to some extent how a stock will move based on how it has behaved in the past. You just simply look to the left of the chart and see how did it perform when it pulled back. You can see it's pulling back in an orderly fashion, consolidating that large gain, a little bit of maybe profit taking, and then again the 20, it bounces right back above it and keeps moving forward. So if you see any repeating patterns in price behavior or movement, that gives you an insight into the character of the stock and what you might be able to expect in the future. It's not a guarantee, but it can help you when it comes time to making certain decisions about buying, selling, or adding to the stock. Also notice that when you take the time to look at the monthly chart and the weekly chart, they're both in a clear uptrend. You don't have to struggle to see if the stock is moving up. It's clear and it's obvious. Moves up, consolidates, moves up, consolidates, moves up. Same with the weekly chart. Price accelerates, consolidates, and then moves ahead. The pullbacks are orderly, and it continues on its way. It's a great advantage and an edge to get to know your ticker through its charts. You annotate what you see on the daily and weekly and monthly charts, and patterns will start to emerge. This particular stock, Sherwin-Williams, which had a great run up, and again you can see on the weekly and the monthly chart, clear uptrend. You get to the daily chart, you can see that it had a tendency to move up, then consolidate for about 2 weeks, and then move up again, consolidate, move up. So this stock accelerated higher in a kind of a stair-stepping fashion. And that information can be valuable when you're trying to make decisions about your stock. You see that each time it pulls back, it finds support at the 20-day moving average. And it's so easy to see in this particular example that Prior resistance then becomes new support. So if you were in a situation where you saw this stair-stepping motion, but on the pullback, the recent resistance did not become support, that would be a red flag. For example, if price, instead of falling back to this line here, fell all the way back to the prior one, that would tell you that some distribution and some weakness is coming into the stock, and to be cautious. You might want to tighten your stops, you might want to take partial profits, but whatever you decide, you're going to pay close attention to the stock because it's no longer moving in a way that's normal or characteristic of that particular stock. So here are a few takeaways you might want to consider. You want to focus on leaders, those with technical and fundamental strength. You want to pay attention to weekly volume and closing prices in relation to prior highs and lows to track the big money footprints. You want to use basic price action and technicals to identify the overall health or look of the stock. Is it reacting bullishly along key price zones? Is it reacting bearishly at key price zones and places of support and resistance? You want to learn how to read price and trend action. Moving average is probably one of the easiest ways to determine what the trend is. The longer the moving average, the more long-term the trend. You want to look for institutional volume on weekly charts. That's the big monster skyscraper volume. You want to be familiar with your ticker's characteristics, how it advances, how it consolidates, where it usually finds support. If you take into consideration the few things that we've covered today, you can greatly improve your ability to identify signs of accumulation or distribution in stocks, and that in turn can help you know when to buy, sell, and to hold.